Hi, everyone, and thank you so much for joining us for the Business Tax in Motion Navigating Key Corporate and PTE Developments webinar as part of our 6 webinar series, Tax Horizons Planning Ahead After the Reconciliation Bill. My name is Michael Ronsky, and I'm a managing director in our national tax practice here at Cherry Becker. In this webinar, we'll break down what the legislation means for business owners, CFOs, and advisors, highlight planning strategies to mitigate risk and maximize value, and offer practical guidance to help you move forward with clarity and confidence. I am pleased to be joined by my esteemed friends and colleagues here who will be speaking with me. Kat Baisley, a partner in our tax services group, Barry Wines, a director in our national office, and last but not least, Will Billups, a tax partner. Starting with an overview of the bill, it's worth briefly noting that while tax is its principal feature, it does include other key pieces of the president's agenda, such as funding for both immigration enforcement and national defense, energy policy priorities, as well as rollbacks of coverage for Medicaid and nutritional assistance, to name a few. But it goes without saying that the expiration of many Tax Cuts and Jobs Act provisions set to take place at the end of this calendar year, 2025, was the principal catalyst for this bill. Now, without congressional action, nearly all Americans would have seen a tax hike in 2026. So to say that this bill was tax motivated would have been a massive understatement. Now, while indeed avoiding universal tax hikes is a bipartisan interest, the crafting of this bill, however, was an entirely partisan process, which took place via budget reconciliation, and that's the vehicle that allows legislation to pass the Senate using a simple majority rather than the 60 votes for yay that are typically needed to advance legislation through the upper chamber. So I'm sure many of you think that, hey, the president is a Republican, the Senate's controlled by Republicans, and the House is controlled by Republicans. How hard could passing Republican legislation really have been? And the answer, my friends, to that question is quite difficult. And that's principally because of the small margins that Republicans hold in both chambers of Congress and competing priorities within the party. So what you see here on the slides, and I won't get into the minutia, but it's a timeline, and the fact that this bill went from soup to nuts so quickly, as shown here, given what was at stake, the very small majorities in Congress that I mentioned, and those disagreements and competing priorities that Republicans had to navigate, the fact that this passed so quickly is really no small feat. And of all the things that Republicans were wrestling with in this situation, the principal source of the trouble was those truly razor-thin margins. Now, what these lent themselves to was the ability for a single lawmaker to exert tremendous influence over the legislative process. And the way you saw that play out here is some folks saying, we've got to have SALT cap relief in this bill. Other folks saying we can only marginally add to the national debt. Others saying the deficit, in fact, has to be reduced. And then on the other hand, last but not least, you have the president saying we need to exempt tips, overtime, and Social Security income from income tax. So really, you had all these things in the mixing pot, and it becomes a nearly impossible soup to stir when you've got all that many ingredients. But somehow they managed to do it. And the way they managed to do it was through seemingly endless negotiations, both behind closed doors and through the press. And as is typical, not everybody got what they wanted, but Republicans ultimately knew that they needed to avoid a tax hike and score a legislative win ahead of the midterm elections. And what we haven't mentioned yet is that the bill also increases the federal borrowing limit by $5 trillion. And that's another ticking time bomb that Republicans and really all of us in government were dealing with. So while Republicans had a perfect storm working against them, they perhaps had an even more perfect storm working for them in terms of what they needed to get done and how quickly they needed to do it. So what you see here on this slide is some of the scoring statistics. Now, from a conventional standpoint, the cost of this bill is quite high, as you can see here. And that's because keeping the bill's price tag down wasn't quite the must-have that it would have been if the cost had been measured against current law, which is how a bill is conventionally scored. And I hope you, or so at least some of you remember some of our previous coverage during the drafting process and the bill's movement between the House and the Senate about the delicate dance Republicans were engaged in over these, who's going to get what they want, what's going to be in, what's going to be out, how is it going to be paid for, etc. But again, as you can see here, the price tag turned out quite high. And this baseline, current law baseline, indicates that the tax provisions in the bill cost just shy of $4.5 trillion. But what Republicans were ultimately able to agree on, as well as the Senate parliamentarian who essentially decides whether a bill's provisions fall within the myriad rules governing budget reconciliation that they all agreed would advance the bill, and that's that the bill would be measured against current policy. What this means is that scoring assumes any provision set to expire by virtue of the law in effect, in this case, the TCJA, is extended based on current policy and in turn have no associated cost. And that's how we arrive at the $715 billion price tag shown here, which is quite the small comparison to the $4.5 trillion. Now, if use of this novel approach had not been agreed to by Republicans, or if the Senate parliamentarian had said that runs afoul of the budget reconciliation rules, negotiations over a maximum amount the bill could impact the deficit and how that maximum would have been adhered to would have been necessary and extraordinarily difficult. So with that overview out of the way, we get on to the heart of our presentation, the business impacts of the bill. And it's safe to say that we have a big three here. And those are the changes that were made to the bonus depreciation provisions, the business interest expense limitation, and research and experimental expenditures. And I say big three because, arguably these are the most prominent business provisions featured in the legislation. And to give a little history here, each of these underwent a taxpayer unfavorable change pursuant to the TCJA's design. And businesses have been stuck dealing with the unpleasant effects since the 2022 tax year, which is when two of those changes took hold, or in the case of bonus depreciation, began to take hold in 2023. But after a bit of a tease in 2024, when it looked for a moment like these changes would have been reversed on a bipartisan basis, that legislation ultimately failed in the Senate, but we finally have our relief now. I won't cover bonus depreciation in too great a detail here, as my esteemed colleague Glenn Lemieux did in our second installment of this webinar series. So please do revisit that episode online if you'd like. But as a quick recap, 100% bonus depreciation is back for qualifying assets placed in service on or after January 20th, 2025, and it's here to stay. There's no more phase down. So before I go too much further, it's really important to say when I note here to stay, what that means is that this permanency is with respect to a provision's staying power per the legislation. And what I mean by that is that statutorily, bonus depreciation is not set to expire. Now, indeed, a subsequent Congress could come and take any of these permanent provisions and remove them or phase them out or what have you. But as I mentioned a moment ago, each of these provisions had bipartisan backing for them to take the form that they have now post One Big Beautiful Bill Act. So again, you never want to say never, but even an entirely Democratic government would conceivably have a hard time politically changing these for the worse from a taxpayer's perspective. So next up is our business interest expense limitation, which is generally limited to 30% of a taxpayer's adjusted taxable income, or ATI. Now, prior to 2022, ATI was calculated based on earnings before interest, taxes, depreciation, and amortization, or EBITDA. And then in 2022, that unfavorable change that I alluded to, the ATI formula switched from EBITDA to EBIT, which is a much more restrictive formula because you can't add back depreciation or amortization from your taxable income to ATI to get to your interest deductibility base. And what that meant was that some taxpayers or many taxpayers were able to enjoy smaller deductions or, worst case scenarios, no current deductions for interest expense. And this really, quite frankly, was a disaster for some folks because this came at a time where interest rates were rising as the Fed attempted to get a hold of inflation. And so when you especially consider the fact that you couldn't add depreciation back, quite a few taxpayers were added to this web when depreciation expense was so favorable, from an accelerated standpoint. But enter the new bill, and ATI will once again be based on EBITDA, and this is a permanent change. Again, I use that word permanent lightly, effective as of the beginning of 2025. And this should undoubtedly provide quite a bit of relief to quite a few taxpayers. Now, what I do want to note in brief here is that this provision also includes an ordering rule that says the interest limitation applies regardless of whether the expense would be deducted or capitalized, say under Code Section 263J or 263 Cap A. I know what this was meant to do was shut down some workarounds that had been espoused, whereby taxpayers would capitalize their interest expense to shorter-lived assets. So as those assets turned around or were depreciated, taxpayers would recover that capitalized interest faster than they would if they were subject to or their interest limited by 163J. Lastly, I will note here that on an international note, in 2026, ATI will also be adjusted to exclude Subpart F income, GILTI income, and certain deductions related to these amounts. So again, really taxpayers are going to benefit greatly from this, especially those who are more leveraged. Next up on the list, and while I know everybody's heard from their new best friend, Marty Karamon, on more than one occasion here, since this arguably is the centerpiece of our feature pieces, and that's the 174/174 Cap A, would allows for the domestic research and expenditures to be deducted currently. That's really been a huge win for many taxpayers. Because, again, as I mentioned previously, as of 2022, another one of those taxpayer unfavorable changes took effect per the TCJA. Taxpayers have had to capitalize all R&E. Now, it's really important to note here, foreign still needs to be capitalized and amortized over 15 years. But starting in 2025, domestic R&E can be expensed currently. Now, if you wish, you still have an option via a Section 59E election to continue to capitalize a newly incurred R&E over 5 or 10 years, depending on the nature of the expenditure. But again, that's just going to depend on a taxpayer's particular set of facts and circumstances, and something they need to analyze closely with their tax advisors. And what you'll see here is that the bill adds quite a few options for how you can take advantage of that current deductibility. And I'll take the opportunity to relay one of my favorite quotes from Homer Simpson, and that's, "Do I have to do anything?" And the answer is not necessarily. You can, if you wish, continue amortizing costs incurred from 2022 through 2024 on their current schedule. You do not have to expense them. Alternatively, you can elect to deduct them over 1 year in 2025 or ratably over the next 2 years, 2025 and 2026. Now that's for all taxpayers. And again, important to make sure everybody knows that that's for domestic expenses only. But there's a special carrot thrown in there for small taxpayers, and those are generally taxpayers with $31 million of average gross receipts over the previous 3 years. They can amend their tax returns in the 2022 through 2024 years and claim those deductions on amended returns. Now, if you do go back to 2022, you have to do so for 2023 and 2024 via adopting a new method of accounting, which will require a method change. And guys, it's really key to note here that a lot of this has not yet been provided for guidance yet. We're waiting on it. Hopefully, it comes out from Treasury or the IRS very soon. I know the AICPA and other stakeholders have lobbied Treasury and the IRS extensively to get guidance as soon as possible because we definitely need it. Um, Now, what option is the best option is going to be unique to any one taxpayer's given sets of facts and circumstances. There are pros and cons to each depending on the entity type, depending on whether you've recently undergone a transaction. It's very important not to jump to conclusions here and think going back and amending my returns and claiming deductions in 2022, 23, and 24 is the best option because it won't necessarily be the case. You really need to work with an advisor to make sure that the choice that you make is the right one for you. Um, so with that, I think we have our next polling question. And that is, will the change in business interest expense deductibility in the formula governing that, will that reversion to EBITDA appreciably impact your tax situation? So as mentioned, you need to answer three of these four upcoming poll questions for CPE. So please get your answers in. And very curious to see what people come back with here. I expect that most folks are going to answer yes, but it wouldn't be the first time I've been surprised. So as you guys are filtering in your responses there, I will go ahead and turn it over to my friend Will, who's going to talk about some corporate specific provisions.
Thank you, Michael. I appreciate the introduction. We're going to start today on the corporate charitable contribution floor. So one of the new changes beginning in 2026, the bill limits the deductibility of charitable contributions by instituting a 1% floor. Broadly, contributions that are equal to or below 1% of the corporation's taxable income are going to be non-deductible now. Amounts exceeding the 1% floor are deductible up to the 10% of taxable income limit that was already in effect. Now there's a provision that says amounts that are disallowed by that 1% floor can only be carried forward in years in which the taxpayer's contributions exceed the 10% limit. So if contributions don't exceed 10%, then 1% is a permanent difference. But if they do, they can be carried forward, making it a temporary difference. So that's an important item to note because we're used to being limited to the 10% of taxable income, but we now have this floor that could be either classified as a temporary or a permanent difference based on each year's activity of contributions. Next slide, please, Michael. Here's another really important provision, and this is one of everybody's favorite. This is 162M. Generally, 162M limits a publicly held corporation's deduction of compensation for covered employees. It's usually limited to $1 million per employee. Historically, the regulations have applied the affiliated group rules under Section 1504 when determining non-deductible compensation. But the OBBBA codifies that if a publicly held corporation is a member of a control group, the 162M limit applies to the aggregate compensation deduction for all members in the control group. So remember that ARPA actually made further changes previously to 162M, where they expanded the definition of a covered employee to add the top 5 highest paid employees during the taxable year. This is commonly referred to as the ARPA 5. and that was for tax years beginning after December 31st, 2026. The OBBA makes it clear that a public company's covered employee group, including ARPA 5, can include employees of the control group. And compensation paid to covered employees by all members is aggregated to determine whether that compensation is in excess of $1 million. This is really important. A control group is determined under 414 B, C, M, and O, which can include entities that aren't corporations. This can include partnerships. This is a really big change from the affiliated group rules included in the current section 162M regulations. So this is going to be really important. Publicly held corporations are now going to have to analyze their control group to determine what entities are or are not included in the control group. And they're also going to have to evaluate the deferred tax asset that they've recorded for compensation for covered employees and others. This is a really big deal because this creates a whole lot of new work and work streams and evaluation for who needs to be included, who's rolling in, how to get the deferred tax asset quantified properly. So having covered that, we're going to kick it over to Kat Baisley for some key tax provisions impacting pass-through entities.
Hello, everybody. I am going to cover just a few things related to pass-through entities. Michael, you can switch to the next slide. I'll be pretty brief because we do have a ton of information still coming at you. What we're going to talk about very quickly is the changes or lack thereof to the pass-through entity tax, excess business loss limitation, and then Barry will be talking to you about the Section 199A qualified business income deduction, as known as QBI. Okay, the next slide. Okay, no PTE-T changes. The pass-through entity tax is an elective entity-level tax that many states adopted as a workaround to the individual SALT deduction or cap of $10,000 that was established by the Tax Cuts and Jobs Act. It allows pass-through entities such as partnerships and S corporations to pay the state income tax at the entity level where it's fully deductible rather than at the individual owner's level. As a very, very quick example, let's assume that a business makes $200,000. It's owned by two people. And assume a 37% federal rate, 5% state rate. If no PTE election is made and the tax paid by the entity, the two members would each pay $37,000 on their $100,000 share of the business income. If the PTE election is made, the entity pays 5% tax, which would be $10,000. That's taken as an expense at the entity level. So now the partners each have $95,000 of taxable income rather than $100,000 to be taxed at the federal level. And that results in a savings of nearly $2,000 each. And that is simply for making the election and paying the tax at a different place. Rather than on their individual return, it's being paid at the entity. So it can be very substantial. And what's important to note about the pass-through entity tax is what wasn't in the bill. Both the House and Senate had proposed limitations, but none of them made it into the final bill. And as Michael mentioned earlier, there's a lot of talk of permanence around what has come out, but we know it's not really permanent. So what we need to do is wait and see what kind of guidance there is now that this is pseudo-permanent, and see what the states are going to do as more states adopt the pass-through entity election, and see who complies, who deals with the expirations that were previously in place, and how to move forward with that. Okay, next slide, please. The excess business loss limitation. I know that is a source of frustration for many of you. That is governed by Code Section 461L, and that limits the net business loss that a non-corporate taxpayer can use to offset other income. Easiest way to think about this is if you have wage income, interest and dividend income, and then income from a business in which you materially participate that comes through on Schedule C or Schedule K, part of K1, if you have a loss of $1 million prior to the enactment of this excess business loss limitation, you could use that $1 million loss to offset any other income that you have. This limits the amount that you can use of that loss. It was set to expire in 2028. It is now permanent. Any losses that are disallowed are carried forward as net operating losses and subject to net operating loss rules. When this excess business loss limitation was put into place in 2018, the loss you were able to take was $250,000 for single filers and $500,000 for married filers. This was adjusted for inflation. So in 2025, it's $313,000 for single filers and $626,000 for married filers. However, under this bill and making this permanent, it has now reset the threshold back to the 2018 rates. And where this is very important, and so many people get so frustrated, is, let's say you have a married taxpayer that has wages of $600,000, interest and dividends of $200,000, and a business loss of $1 million. You cannot use that entire $1 million. You will only be able to utilize $626,000, which is the 2025 limit, to offset your other income. The remaining $374,000 of loss that you incurred, you will have to treat as a net operating loss, carry that into the future, and the net operating loss rules apply, which means you can only offset 80% of your taxable income. And similar to the pass-through entity election, the House had some other proposals that weren't included that would add further limitations. So although this is permanent now, we know it likely won't be, but this is something that impacts a lot of people, and they're often caught surprised by it. Okay, next slide, please. And the final piece that I'll cover is the SALT cap. The SALT cap is the legal limit on the amount of state and local taxes, SALT, that can be deducted on your federal income tax return for taxpayers that itemize their taxes. The Tax Cuts and Jobs Act originally capped the deduction at $10,000 for most filers. The OBBA made the SALT cap permanent and increased the limit from $10,000 to $40,000. Sounds great. However, there is a catch. There is a phase down with the SALT cap. For filers with a modified adjusted gross income over $500,000, the deduction is reduced by 30 cents with a floor of $10,000, which means that any taxpayer with modified adjusted income of $600,000 or more is going to be limited to the original $10,000 SALT deduction. People that will really be impacted by this are those high income earners in high tax states. Think California, New York, New Jersey. They won't get as much benefit. And for high income earners, you still will likely be phased out in some form or fashion. What this means is, kind of going back to the first thing I spoke about, the pass-through entity tax. That is still incredibly important, and the planning around it is still essential. You will want to work with your tax advisors to ensure that you are maximizing the amount of deductions that you can take. Next slide, I believe, will roll us right into our next polling question. Pretty easy for all of you out there. Do you need assistance with an area of tax reform? Individual taxes, pass-through entities, corporate taxes, all of the above. We did not give you an option of saying none, because this is brand new for everybody and everyone has something to learn from this. So, and kind of rolling us into our next section will be Barry. And Barry, I will let you take it from here.
Great, thank you. So we're going to be talking about navigating some of the key corporate tax entity selection updates. So we're going to talk about three of the provisions that have an impact on what type of tax entity you want to be. So if we go on, the first thing we're going to do is talk about percentage of completion. This really applies to real estate. So this provision changes the rules for certain contracts, but the contracts are only for those entered into after July 4th, 2025, or beginning on and after the July 4th, 2025. So in the construction world, if you had home construction contracts, you had some favorable accounting method changes. If you had what was considered residential construction contracts, the rules were a little bit more favorable than a full percentage of completion, but not quite as beneficial as home construction. So what they did is they changed the terminology, and now these residential construction contracts are going to be the same as home construction contracts, which allows a much more beneficial method of accounting. So this is going to allow builders of the multifamily homes, the apartments and the condos, which obviously seem to be springing up everywhere. They're going to be able to opt out of the full PCM, percentage of completion method, and instead they'll get to use, it used to be a 70-30 method, now it's a 90-10. Additionally, there are going to be AMT benefits for that. There won't be the adjustment. The requirement for certain small businesses is increased. So instead of the project being done in 2 years, it's now 3 years. So this is beneficial for those industries that are constructing multifamily environments. So let's move on to entity selection. So we're going to talk about two provisions here, and we're going to talk about them in a little bit different light here. We're going to talk about them in entity selection. So generally, entity selection is when you form a brand new entity, the question becomes, what type of entity do I want? Do I want to be a C Corp, an S through, a partnership, a pass through, or something different? The other time that you should think about it is periodically, should I be switching the entity type? Has something changed either in the business or in this case in the tax law that would make sense for me to re-examine those choices I initially made? Back in 2017, when TCJA came in, then again, a lot of that was switching entity types. There were some specific provisions in there that were encouraging. Those provisions aren't in there, but it's still an analysis that you can go through. When you think about what should I be thinking about in doing this, there's really two factors. First of all, what's my cash flow going to look like during the operating phase? And the reason for that is, am I generating a profit? Am I generating a loss? Is it all being plowed back into the business? Is some of it being pulled out by the owners as a return on their investment? And then ultimately the question is, what's my exit strategy? How am I going to get out of this business? Very few businesses are meant to be passed down from generation to generation anymore. If that is one, then that clearly is something you need to think about. But if not, the question is how, when, how long am I going to do this? Is it going to be a financial buyer? Is it strategic buyer? I always tell people that at the beginning, you need to think about how this whole story is going to end. Hopefully they all end well, and that's what we should plan for, but you need to be careful there. Just remember, though, one of the things to think about here is we're just talking about the tax aspects. There are going to be business factors that you're going to need to factor in, non-tax reasons for making that selection. So you need to make sure you take into account all of these. So two of the drivers that were impacted by the new tax act here in 2025 are Section 1202, Qualified Small Business Stock, QSBS. You'll probably hear me refer to it 1202. I play a lot in this area. It seems like I have at least 2 or 3 calls every week about this. And the other area is a Section 199 Cap A, Qualified Business Income, QBI. Those two provisions will help determine whether you want to be a corporation or a pass-through. 1202 is going to favor corporations. 199 Cap A is going to favor pass-throughs. So let's talk about each of these here to start with. So one caveat is we're going to talk about this in general at a very high level. There are so many nuances in 1202. You really need to examine it for whatever your situation is. But here are the 3 big changes that really enhance the 1202 benefit. So, but they only apply to stock issued after July 4th, 2025. So if you had stock that was 1202 eligible prior to July 4th, 2025, nothing has changed. Those benefits are still there. The rules are still there. It's only if there's new stock issued after July 4th. So one of the things that the law did is it increased the exclusion. So under 1202, the old rules was I could exclude the greater of $10 million or 10 times my basis in the stock. So if I had basis under $1 million, then it's going to be the $10 million, which means if I sold that stock, I could exclude $10 million of gain from taxable income up to that amount. So that's a significant tax saving. The new law has increased that. It's now the greater of $15 million or 10 times basis. Additionally, that $15 million is going to be indexed for inflation starting in 2027. The bigger change here was the holding period. Under the old law, I had to hold that stock for 5 years to receive that $10 million exclusion. So it was all or nothing. 4 years, 364 days, I lose. 5 years and a day, I win. Now, the new law has changed that. Once you get past a 3-year hold, then the exclusion is 50% of the gain. So up to a $15 million gain, I could exclude 50% of that. That potentially is $7.5 million. If I get to a 4-year hold, now the exclusion is 75% of my gain up to the maximum total gain of that. And at 5 years, it's the 100,000. So the benefit here is that the hold period has been shortened to receive some of the benefits. There's some nuances in how this exclusion works, so you need to work through the details in making this. The other thing that happened is the company size has increased. Under the old law, when I invested in one of these companies, it had to have less than $50 million of gross assets at the time and immediately after I invested. Now the new law has increased that to $75 million, and it also has indexed that amount for inflation. Again, all of these apply only to stock issued after July 4th. But what you can see here is I've increased the exclusion gain, so more tax savings. I've shortened the holding time period, which is to get some benefit, which is great. And I've also increased the size of the company. So the 1202 benefits are now available for a larger swath of companies. So let's talk about what that really means. So if we go to the next slide. In order to have qualifying small business stock, there's 2 tests here. First of all, the individual test. So in order to gain this exclusion, it has to be an individual or trust who owns a qualified small business, okay, and can exclude the gain. C corporations are not eligible. Pass-throughs, meaning S corps or partnerships, are eligible to pass through any 1202 gain on stock they own to their partners. There are rules associated with that, so you have to be careful how those entities are handled, but that's basically what the rules are. You have to hold the stock, you have to hold it for the requisite period, again, whether it's 3 years, 4 years, or 5 years, depending on when you received it. And it has to have met those qualifications. The company has to be a QSB, a qualified small business, okay? So the company has certain qualifications that we'll talk about in a minute. The shares have to be directly from the company. I cannot buy shares. I cannot buy shares from another owner. I have to receive the shares directly from the company, generally for property services or wages or compensation. And then obviously I must hold it for the requisite period. If the shareholder meets the requirements, then they're going to be eligible for the gain. All right, so let's talk briefly about what a company needs to do to qualify. So next slide, please. There we go. So in order to be a qualified small business, these are the qualifications the company has to meet. The company must be taxed as a C Corp. So it can be an LLC taxed as a C Corp, or it can be a straight Inc. taxed as a C Corp. It doesn't really matter there. The company must be in a qualifying trade or business. Section 1202 defines qualifying trade or business, what cannot be. Basically, it's service type businesses, certain real estate businesses, insurance, and other things. So it must be in a qualifying trade or business. The company has to use 80% of its assets in the qualifying trade or business. So this one seems rather simple. Hey, I'm using all of my assets in a trade or business. The complications and the nuances come in is that if I have real estate that's not used in my business, such as that I'm renting it out. So if I have a building that's used in my business, but I'm not using all of it, and I'm renting part of it out, if too much of it's being rented out comparatively to my overall business, then potentially I don't qualify. If some of my assets are held in other corporate securities or corporate bonds, then potentially, again, I don't qualify. But the biggest kicker here is that in my 80% asset test, there's a lot of nuances around how much of my working capital do I actually get to count. First, it has to be reasonable, and then it has to meet certain thresholds. So just because it looks like somebody qualifies, just because, hey, all of my assets are used in the trade or businesses, there are nuances here. The other thing is so we have a asset test here, and we had the $75 million asset test. They're completely different. The other asset test uses tax basis subject to certain rules. This asset test uses a fair market value. So again, there's a lot of nuances to how you compute that to make sure you're meeting that requirement. And then lastly, the company has to have not had any disqualifying redemptions. So meaning when the company buys back shares from its shareholders, if it buys back shares and then turns around and sells shares either a year before or a year after, those shares won't necessarily qualify for 1202. So again, all of these things need to be looked at in order to determine whether the business qualifies, whether the stock qualifies, so that the individual will be eligible for that gain. All right, so let's talk about 199 Cap A real quick. So this is qualified business income. So there were changes in the 2025 Act. What basically happened is that these provisions were set to expire at the end of 26, and they were now made permanent. They also adjusted the phase-in for certain limitations. So as we'll talk about in a moment, is there are certain rules to compute how much of a benefit you get. Those rules phased in, they up the phase-in range to make it easier to qualify. They also added a minimum number. If you have at least $1,000 of qualifying income, they just give you a $400 benefit. So there are a few minor changes in it, but the biggest one was that they made these things permanent. So let's talk about, again, what is 199 Cap A, especially when we're talking about an entity selection. So next slide. So the highlights of 199 Cap A is basically they apply to non-corporate taxpayers. So 1202 is corporations, C Corps. 199 Cap A, is pass-throughs, meaning S Corps and partnerships. So what the intent here is the individual tax rates now after 2017 are significantly higher than the corporate rate, potentially up to 37% versus 21. So what the 199 Cap A says is, hey, if you have qualifying business income as defined, we're going to give you a deduction of 20% of that. Okay. So in essence, if I make $100,000 and I qualify, I'm only going to pay tax on 80% of that because they're going to give me this 20% deduction that's not really a cash deduction. Okay. Now the amount of the 20% can be limited. There are limitations based on how much the wages are paid. So they want this to benefit companies that are employing people. Again, we also are limited to certain qualifying types of businesses. They pulled these rules from our 1202 rules. So Generally, if you're qualified for 199 cap A, you'll qualify for 1202, but there are some nuances around the edges of that. So the overall impact here is to reduce the effective tax rate applied to business income. So if you think about our individual tax rate, the top marginal rate is 37%, meaning if I'm earning income at that rate, I'm paying 37% dollars, 30% tax on every dollar I own I earn after that. With the 20% reduction, I'm effectively cutting that top marginal rate to 29.6. That looks a lot more comparable to the 21% rate for corporations. And again, those are the things that you can think about in trying to figure out what type of entity I'm going to be. So let's sort of wrap this back up for how it impacts entity selection. So next slide, please. So in entity selection, 1202 favors the C Corps. First, there's a lower corporate tax rate of 21%. So as we talked about, if I'm generating income during my operating time, I'm paying tax at a lower rate. Clearly, there's state issues that we have to deal with, but again, we're talking federal. The benefit here is on the exit to the shareholders. They get to exclude when they sell the gain. The only drawback here is that if I sell stock within 3 years, nobody gets a benefit for this. So I'm stuck into the C Corp rules. 199 cap A favors pass-through. It lowers the effective tax rate to 29.6. On exit, generally the owners can receive capital gains rates of 20% because I'm selling all the assets. But you need to be cautious or excuse me, one of the big challenges here in doing this analysis is that different owners will be impacted differently. In 1202, I can have an owner who has acquired their share at the beginning. Somebody comes in 2 years later, acquires their share, and now we want to sell a year later. Well, the shareholders who acquired initially are going to get the benefit of 1202. Those who acquired later may not. So again, that puts sort of a conflict there. 199 cap A, again, that depending on how the owner participates in the business and things along those lines, that can also have an impact. And you also have to be careful because, it's one thing to make a decision when the entity is starting. It's another thing to switch from one entity to another. So you need to be cautious about switching entity types. There are traps where you can make a switch depending on where you're going and how you're doing it may not be tax-free. So you need to consider that. The other thing you need to consider is switching, especially from S Corps, thinking you're going to get 1202 has to be done in a certain way to acquire that benefit. So it would be really problematic thinking, oh, I'm going to switch from an S Corp to a C Corp and expect the 1202 treatment only to find out that you didn't do it the proper way. So again, that's taking these sections and applying it more to the entity selection, but obviously they're standalone. That brings us to polling question number 3, which is, do you think you will engage in any analysis concerning entity selection? Yes, no, or maybe.
Thanks so much, Barry. While folks are answering that question, I had a couple questions come in that I'm happy to take. One being, do you anticipate any future tax legislation in the near term? And I'll be coy if I can and say you never want to prognosticate when it comes to Capitol Hill, but the other thing I'll say is that it depends on who you ask. I think folks in the House on the Republican side are eager to try to get another bill through, particularly due to the fact that it was a lot of House Republicans who were really advocating for there being more to reduce the deficit, which, as we saw in one of our earlier slides, did not end up happening. There's also a few other extenders. The TCJA was the big provisions due to expire at the end of 2025. That was, they were addressed. There were a few others hanging out there that did not get addressed, such as the enhanced premium tax credit for the Affordable Care Act premiums. Those are set to expire at the end of this calendar year, absent further action. On the other hand, you've got, folks in the Senate who quite aren't quite sure what the urgency is. The president, meanwhile, has not, he has not come down, or at least as I'm aware of, either way. But it's important to note that he had a few campaign priorities that did not make it into the bill that we're speaking about now. That being doing away with the carried interest provision, as well as a reduced rate for corporate manufacturers. So it's a great question. TBD, I would say at this point. But senators and representatives will be back on the Hill before we know it, and we'll see what happens once that happens. Another question was, for those who are eligible to amend returns to take advantage of R&E expensing in 2022 and 2023 and 4, do they need to worry about the impact of those expenses on their 163J limitation? And that is a fantastic question. And the answer to that is absolutely. So, as we mentioned previously, absolutely need to model these things out before you rush to any conclusions, because what yields you a good answer on the R&E front could yield you a bad answer on the 163J front. So again, urge you to reach out to your tax advisors and work through these issues.
And Michael, there were two questions in the 1202 section that I'll address real quick. One question was, if you went over the $50 million limit, but now are under the 75, would you be able to issue new shares? The answer is yes, assuming those shares were issued after July 4th of 2025 and you never went over the 75. So they've sort of reset that limit. And then one other question was, S corps are not eligible for 1202. You can convert an S corp to a C corp and make it eligible, but the manner in which you do that is very important to make sure you do it the right way. Just unchecking the box or converting to a C corp will not do it.
Thank you, Barry. More great questions. Another one came in on research and experimental expenditures. What if you have not filed 2024? Can we expense those if I am considered a small business R&D for the year? And that's another terrific question. We are waiting on IRS guidance for a lot of this stuff. We don't have it yet. Again, we are the IRS has been lobbied heavily, but as many of you know, they are working with a smaller roster and with fewer resources than as is usual. But I give them all the credit in the world. They have released some tax reform related guidance already, such as the guidance on the energy credit sunset. Really tip my hat to those folks for making quick order of that. So let's see, any other questions that have come in that we can answer. Any chance the 3.8 net investment income tax will be reduced, or the 250,000 threshold increased for inflation? Great question. Never want to say never, but that would indeed cost the government money. And in a situation that we're looking at right now, where many Republicans are opposed to increasing the deficit at all, difficult to see that coming to light. But we will see what happens. Do you want someone from Cherry Beckert to reach out to you about the topics discussed today? If so, we would be happy to. And as you guys are filling in that question, it is my pleasure to wrap it up for you all today. Thank you so much for joining us. I want to give thanks to my wonderful co-presenters as well. If you do have any questions, please reach out to us at any time. We do value your feedback and ask that you participate in the short survey that will appear when you leave this session. Recordings will be available in about a week. Our previous sessions are also available online, and I want to shout out to our upcoming webinars as well, if I can. So, New Global Playbook International Game Changers will be on Wednesday, September 5th, and that's at 12 Eastern. And then our last installment of the series from capital to capital to county, state and local tax in focus, Wednesday, September 24th, also 12 Eastern. I know those will both be very, very, very well worth your time. So again, thank you so much to all of you for joining us, and I hope you have a great rest of your day.